Don't you ever wonder when the right or the wrong time to invest is? Like, you've likely thought about this at some point when you have funds ready to invest, right? Well, the market, especially since April 2020, seems like it's been on fire and can't be stopped, which then leads you to wonder if you're better off waiting it out, right? I mean, I certainly have been there before. I still have to remind myself of this when I go to add funds to my investment account, and I think, what if the market were to drop tomorrow? Should I just wait until next week? I mean, it's human nature to do this, so don't feel guilty for thinking this way. Now, as humans, we are naturally risk averse, so we tend to think about the potential negative outcomes when making decisions. Sometimes, those negative thoughts can far outweigh the positive thoughts, and this is likely some evolutionary concept that helped us survive as humans, right? I mean, I guess if we only thought about the positive outcomes, we'd live in some fantasy world where the market only goes up and up, which kind of feels like the last couple of years, right? Okay, let's not go down that rabbit hole. Let's instead talk about how you can train your thoughts to put yourself in the best potential position so that you have the best investing mindset to build wealth long term. Since March 16th, 2020, when the global stock market reached its bottom point, the market has gone up about 93%. Now, you only actually achieve that return if you actually invested all of your money right on March 16th, 2020, when the market reached that bottom. But how many investors out there actually did that? I mean, the market was in a free fall, and no one even saw any end in sight with the pandemic and how it would impact the economy, right? So it's probably better to look at the total market return since January 2020. And in that case, the market is up about 33% in that time frame. Now, we should probably keep a wider lens on and look at the market with the proper time frames when talking about returns, right? But while the market has gone up, there have certainly been some rough days in getting there. So let's just look at October 26, 2020, when the market dropped over 5% in one day. I mean, if we hadn't seen such massive single day crashes earlier that year, this would have looked way worse. Or how about February 22nd, 2021, when the market dropped over 3.5%? Or even September 2021, when the market that month was down for about 5%. It wasn't all green every day to get where we are today. Okay, so we can all agree that waiting for a market pullback might feel like the right thing to do. I get it. But studies show that time and time again, this type of waiting game is likely leading to worse outcomes more often than positive outcomes. The best way to actually show this is looking back at the historical data of the stock market and then running tests with that data. And we refer to these as back tests. This is really the best way to show how different scenarios turned out when it comes to investing. And to do this, we'll assume you set aside $100 at the end of each month for investing. In each market day, you check for a market decline and decide whether or not you want to invest. If you don't invest, your money earns daily interest equal to a 1-month treasury bill, which is more than most traditional savings accounts would actually pay you. If you decide to invest, you invest all the money you've set aside since the last time you invested, plus any interest you've earned since then. We'll use 30-year returns of the S&P Total Return Index, beginning October 1, 1991, and then ending on September 30th, 2021. To understand how your investment would have actually performed during these back tests. So over that time period, if you would have waited until the market dropped, let's say 10% each time to invest your money, meaning you held your cash out of the market until you saw that 10% drop, you would have been left with about $175,000. So it's not too bad, right? Now, if you would have not waited at all and simply invested that $100 each month instead of setting aside the cash to wait for downturns, you would have ended up with over $218,000. This means that you would have missed out on over $43,000 in returns by waiting for those big market drops, and in this case, 10%. Now, this table does a great job of showing the final values of your investment in each scenario if you would have waited for a certain market decline to invest. And the results are pretty straightforward. The larger market drop you wait for to invest, the more you're likely missing out on long-term investment performance. But this one doesn't really make sense, right? Like, if you manage to actually buy the dip in these scenarios, wouldn't you expect the end value to be higher and not the opposite? I mean, if we look at the scenario in which you would wait for, let's say, a 5% market drop from the previous year's peak, meaning you actually do successfully continually buy the dip on average, you'd expect better returns, right? Well, because the market is rising overall, you end up missing out on earnings in between those dips and end up leaving hundreds of dollars on the table uninvested. And that's the key here. It's not that you don't successfully buy a dip, it's that you're missing out on big runs in between those dips. But why does waiting to invest or buying on the dip not always work out to your benefit? One word: time, or compounding to be exact, so 2 words in that case. When you wait to invest, you give up time in the market and your returns have less time to compound. The less time your returns have to compound, the less your funds will grow and the less money you'll likely end up with in the end. Whatever that end is. The more time your money is sitting in cash, earning a measly interest rate waiting on the sidelines, the more you're putting yourself at risk of missing out on the good days. And like we talked about previously, the historical market over a long period of time shows a clear trend in that it goes up, right? And if you wait to invest, you might succeed occasionally and, actually invest on a down day or relative low point, but you're also likely missing out on a bunch of those good days when the market was rising in between. So you might buy on that dip, but you'll also probably get burned as well because no one actually knows when the market's going up or down consistently. You're just putting yourself in a position where you're increasingly likely to miss out on some key market days that end up having a massive impact on your overall returns. So if you've made it this far, you should probably hit the subscribe and the like button so other viewers see this video and you'll get notified every time we release new content. Let's not make this the last time that we see each other, right? All right, so there's an interesting study done by Putnam Investments in which they looked at the 10 best days to invest from January 1, 2004 to December 31, 2019. So it's about 15 years that this represents. This represents over 3,800 days during which the markets were open. If you were to have invested $10,000 and just kept it in the market during those 15 years, it would have multiplied to about 30,711, a 7.77% annualized return. However, if you missed out on just the 10 best performing days, we're talking about 0.26% of the total trading days, the total value of your portfolio would have grown to 15,481. This means that missing those 10 best days would have wiped out about half of your returns. You could have seen if you just stayed invested over that time frame. So another way to say this is having your money in the market during those big comeback days has a massive impact on your returns. In this case, that's 10 days out of 3,800 that accounts for over 15,000 in returns. That's massive. And if you were able to tell the future, you just say, well, I'll make sure I invest before those 10 best days, right? But no one can actually tell the future. No one can consistently predict what the market will do, and no one can buy that dip over and over again. And if you wait out those dips, chances are you're not going to get your money invested ahead of those massive comeback days. And that's the key. Now, I'm not saying you won't ever do it. I'm simply saying that each time you miss out on those huge comeback days, you're really hurting your returns, big time. So what's the takeaway? Patience and staying invested for the long term are crucial for the greatest long-term benefit. Straightforward. If you put money in the market as early as possible and keep adding to it over and over again, you'll take out the guessing game of picking out the best days, and then you can likely benefit from the general market upward trend. This also allows you to get your money to work instead of sitting in cash in a bank account where it's probably not even keeping up with inflation, let's be honest. Now, I also don't want to preach, right? I'm not going to tell you what to do with your money. I simply just want to present the evidence to give you an idea of what strategy puts you in the best position long term. If you love waiting for those days when everything's flashing red and Wall Street is panicking and TV hosts are, sweating through their crisp white shirts, have at it. Just make sure that the majority of your funds are set up properly, diversified across the global market, and are getting as much time in the market as possible. As we always like to say, time in the market is more important than timing the market. Time in the market is more important than timing the market. If you really want to take the emotional aspect out of this and you don't want to invest all your cash at once, I get it. You can also consider a dollar cost averaging strategy. This can be a great behavioral tool to get past the fear of seeing your investments go down potentially all at once, right after you invest them. Dollar cost averaging really just involves breaking up a large initial investment into smaller chunks that you invest on a regular basis. So instead of depositing, let's say $5,000 you saved up today, you might invest $1,000 every week for 5 weeks to lessen your fear of picking the wrong day. It's not always going to get you better returns in this case, but you can use this strategy if you need to get the emotional aspect out of it. All right, thanks for watching. My name's Tony from Wealthfront. Stay tuned for more content. I'd love to see you subscribe to our channel.